Financial lessons I should have learned in school. Taxes. Welcome to lesson 4 of our financial lessons tax course. In this lesson, we will focus on special situations. The final consideration to determine tax liability are phase-outs. Phase-outs are where certain deductions and credits begin to phase out as your income reaches certain thresholds. The higher your income goes, the more these credits or deductions will begin to phase out. The important thing to remember is that the higher the income, the more you're going to have to take note of whether or not a credit or deduction is going to continue to apply for your situation. So, income thresholds for phase-outs vary by type of credit and tax filing status, but most start to phase out when the adjusted gross income exceeds $75,000 for single filers, $112,500 for head of household, and $150,000 for married filing jointly. However, keep in mind that this is only for certain types of deductions and credits. Each one has their own separate limit. So, for example, the earned income credit limits or thresholds are much lower than the ones that I've shared here. So it's up to you to make sure you do the research to determine when your credits or deductions, those that you qualify for based on your situation, when they phase out per credit or deduction. The next set of special circumstances that we will cover are the special deductions and credits available for certain groups. There are different vulnerable populations that have more deductions and credits that are specific to those particular groups. This is not everything, and of course, as I've stated before, it's not an exhaustive list, but these are the most common. So we have the elderly, those who are over the age of 65. They get a higher standard deduction, and they can also take advantage of the elderly tax credit depending on their situation. Many states also have additional tax benefits for the elderly. So you're going to want to check with your state to see if an additional benefit exists for you based on your situation. Next, we have veterans. Disabled veteran pay is not taxed by the IRS. If you are disabled or someone that you care for, they could qualify for the disabled tax credit or the dependent care credit if your spouse is paid to provide care for you or if you provide care for your spouse. Next, we have disabled. So, individuals who have a disability, if they are your qualifying dependent, their therapy and medical costs related to their disability are deductible, including transportation to those facilities where they receive that therapy or that care, as well as modification to vehicles and homes, and a lot of other things as it relates to their disability, items that you have to purchase in order to care for them. So a lot of these things are very nuanced. You're going to want to get with a tax professional if you fit into one of these categories or you have a qualifying dependent that does, so that that professional can work with you to go over your specific circumstance and determine what you're going to qualify for. Lately, we have heard a great deal about recession concerns, and although these may have dissipated when you take this course, these principles are always sound advice to follow. So, in the event that a recession is looming, you're going to want to contribute more to your traditional IRA or HSA, health savings account, if you can. Everybody is not going to be in a position to do this, but if you can, in order to help lower your tax liability, as well as benefit yourself in the long run. If you're able to contribute more, then these are adjustments that can be made to your income, as well as benefit you as you begin to age, and you'll be able to take advantage of having that money saved. You're going to want to create a tax plan so that you are able to anticipate and pay your tax liability early on to help avoid penalties, interest, liens, levies, and financial hardships. So you don't want to wait until tax time to learn that you owe money. You can sit with a professional and have them go through your financial situation in January or February, or when they do your taxes. And that way you're able to not only anticipate what you're going to owe, but you can go ahead and put plans in place to make sure that you are contributing enough every month so that when that time comes, you don't owe anything. And you're going to want to especially remain in good standing with the IRS and resolve any outstanding debts and tax liabilities. And this is important for a number of reasons, and we'll cover that in subsequent lessons. So, in summary of lesson 4, phase outs occur when income limits are reached and impact your tax liability greatly. So you don't want to be expecting to have a credit and then learn at the last minute that you're not going to have that credit because your income is too high. So you definitely want to make yourself aware of these phase outs. There are specific tax breaks for vulnerable populations. If you or a qualifying dependent fits into one of those categories, make sure you're educating yourself ahead of time so that you know about these. These can mean the difference between owing the IRS or being able to take a critical credit or deduction that will put you in a situation where you don't owe money. So you definitely want to know if you're able to take advantage of one of these. And then prepare for a recession by being proactive and thorough in your approach to your tax liability.